$1 here, $2 there, $10 somewhere else. Most bank charges don't feel like very much.
A transfer, a card, a teller transaction, a wire, a monthly charge. A little money disappears each time.
But a little money, multiplied across hundreds of thousands of customers and millions of transactions, isn't little anymore.
And those charges are only the part of the banking business that you can see.
Because the real money is being made somewhere much deeper inside the system. So how exactly do Trinidad and Tobago's banks make so much money? The bank combines deposits with its other funding, then uses its balance sheet to make loans and investments.
And here is where the basic business model becomes clear. Banks generally pay less for money than they earn from lending it.
In March 2026, the average deposit rate was 0.92%. The average lending rate was 6.85%. Interest is the engine. Everything else adds another layer. And scale changes everything. Trinidad's major banks aren't dealing with thousands of dollars, they're dealing with billions. Read their financial statements, and the size of the business becomes obvious. First Citizens reported about 2.1 billion Trinidad and Tobago dollars in net interest income for its 2025 financial year. Scotiabank Trinidad and Tobago reported roughly $1.54 billion.
Since 2016, Republic, First Citizens, and Scotiabank have generated more than $22 billion in after-tax profits. Part of that $22 billion came from something very ordinary. You putting your money into the bank, then paying to use it.
When you tap your debit card, it might look free. But the business pays the bank to accept your money electronically. Sometimes you pay 75 cents. A balance inquiry can cost 60 cents. Even a declined transaction may have a charge. Use another bank's ATM, and the charge is commonly around $4. Even a declined ATM transaction can still cost you. Your money is in the bank. And sometimes, you pay the bank just to get to it. Accounts, tellers, transfers, ATMs, wires, cards. Different banks charge differently, but the menu can be long. What is almost invisible to one customer can become meaningful revenue at the scale of a national banking system.
You went inside. You sat down. A teller counted the money. A human being performed the transaction. For older customers, banking once felt very different.
Then, technology changed the relationship.
Today, you transfer the money. You enter the information. You use the machine. You increasingly perform the transaction yourself. The central bank's own review found banks actively moving customers toward lower-cost digital channels as part of their cost strategies.
Which creates an obvious question. If customers are doing more of the work, how much of the saving is coming back to them?
This isn't simply nostalgia for chairs and counter service. The economics of banking really have changed. Routine transactions that once required staff can now be processed electronically, at enormous scale.
For the bank, that can mean efficiency. For many customers, it means convenience.
But convenience isn't distributed equally. Not everyone is comfortable doing everything through a machine or a screen.
Because efficiency for the bank can shift another kind of burden onto the customer. Imagine you've run a small shop all day, and you're holding thousands of dollars in cash. That money now has to get from your business to the bank. The risk isn't necessarily the machine itself. It is carrying, transporting, and handling cash along the way.
There have been documented robberies involving people carrying money to or from financial institutions and ATMs.
Making money isn't evidence that a bank is doing anything wrong. A profitable banking system is generally preferable to a failing one.
The more interesting question is whether customers are getting a fair deal in return.
Banks would answer that modern banking isn't cheap to run. They have to protect digital systems, fight fraud and cybercrime, and maintain payment networks around the clock. The question is whether the benefits and the costs of modern banking are being shared fairly.
For many hard-working Trinidad and Tobago citizens, the answer is no.
And even the regulator has been asking questions about bank charges. One customer is small. Hundreds of thousands of customers, billions in deposits, and millions of transactions are not. For many customers, the frustration isn't that banks make money. It's that the relationship has changed. Today, customers do more of the work themselves. Yet many people feel the fees haven't disappeared. That matters because banking depends on trust.
Banking once felt personal. Today, many customers feel like they're serving the bank instead. Trinidad and Tobago has several commercial banks. But the real question is whether there is enough competition to make them fight harder for customers on price, fees, and service. People often say, if you don't like your bank, move. But changing banks is not always simple. Your salary, mortgage, credit card, standing orders, and loans can all tie you into one banking relationship.
Banks do compete, but when customers see similar kinds of charges across the market, it is reasonable to ask how much pressure competition is really putting on fees. The central bank has also raised questions about how some bank charges are set and explained. It has called for stronger governance, clearer disclosure, and better justification of fees. A healthy economy needs strong banks.
More competition can give customers more choice and put greater pressure on banks to compete on price, service, and value. The goal isn't weaker banks. It is a better balance between strong profits and fair value for customers.
The real question is whether customers are getting fair value in return. Please like and subscribe. Thanks for the help.